going forward. We have some relative equal highs up here, so there's buy side liquidity. And we can anticipate price running up into these levels here, and then we have standard deviation -1. Now, what is that measuring? Like, what is it that you're actually getting from that? You're getting the range low of the midnight opening range, that 30-minute interval between midnight and 12:30 Eastern time. If the market trades above it, then it can go 1/2 of one standard deviation or one standard deviation. So in other words, the actual range from the high to low, that range added to the high. That's all it is. So think like measured move. How hard and fast it goes to that degree of premium or discount is relative to an economic calendar event during London. This is a very easy brass tacks approach to finding the one or two levels that generally, not all the time, but generally will deliver what you're going to be looking for a daily high or daily low. We have relative equal highs over here. You see that? So this one here is enough to do that. It trades up into it there. But then we have standard deviation 1 up here. So watch what happens later on in the day session. But for right now, I want you to look at what we have in London. Okay. We have the standard deviation based on this inefficiency. If we take the range from low to high, that's this low here to that high, half a standard deviation, one standard deviation. If we use the inefficiency, we can do the same thing there, where we can take those levels and now we'll plot them from low of the inefficiency to the high. This inefficiency here, if we use that same idea of standard deviations from that, we can also get very, very precise elements to how the algorithm will rebook and redeliver to premium and discount, even inside of that midnight opening range. What do I mean by that? Well, this is first presented displacement. Okay, the displacement in and of itself is a PD array. Remember, we already had a inefficiency offered here. Okay, so it's not that it's, sell side imbalance in of itself. It's a very large one, and it's occurring inside of the midnight opening range. So it jumps off the chart. It's the first presented displacement. Notice that? So what happens when I add these same levels that are here, -1 and -0.5? What if I add that to this inefficiency on the upside? Well, you get these things like this. You get the 50 or half of it. That's this level here. Look what the bodies are doing. You see that? Look at all this. The close of that candle, the open of that candle, all this consolidation around there. Look at the bodies here, and it moves away from it. And then we have the -1 standard deviation here. What is it doing? It's creating this delivery of that high. Look at the bodies working around that and all the consolidation around here, and it runs away from it there. Now, what happens when we use this same idea and we add it to the projection below this inefficiency? You start from the high down to the low. -0.5. You can see how we're working this level here, and then finally at -1 standard deviation, we see it here, and then rallies and starts working inside of that displacement in and of itself. So we can see there's boundaries that can be created with this. So the markets are absolutely not random. So therefore the market stopped, turned on a dime, reversed, right? Wrong. Same thing here. The market is just going to randomly go down to that level here, stop, turn around, and go higher simply because sellers are no longer interested in going short and or buyers overtook the buying or the selling of short sellers. That's not how the markets work, folks. And ain't going to do it either. But now watch what happens. When we trade outside the band of this range, notice we're probing below it here. But it's only going one standard deviation of this inefficiency with that low right there. Look, see? Look at it. It's controlled. It's only allowing one standard deviation outside of this when it went lower. I'm not interested in seeing it go below that low because I don't think it's going to do it. Why? Why was I interested in only getting out when it went down here? Why was I doing that? because this inefficiency told me that this one standard deviation down here is about as far as it'll go once it trades to my target 3. So once we get back inside of this inefficiency that's in purple, then I can start looking at the quadrants, the consequent encroachment, and the high and the low, the actual inefficiency. So you can see the low of the inefficiency here. Again, that's this candlestick's high. It's supporting it here, rallies up to upper quadrant, trades back down. It trades just outside of it here, but then goes right back into the middle and starts consolidating around the consequent encroachment or the midpoint of that purple area. Then the market trades one more time lower, and now it's allowing price to go outside the range of this inefficiency because it's it's enticing. It's luring traders to go short, and it's probing for liquidity below this low, and anything that's around here, they'll probe at and try to see if they can get that. But they got a short-term low here. They worked below that and then rally back up inside of that purple shaded area, which is the first displacement in the midnight opening range. The market rallies back up, trades to the high of the opening range at midnight here, then back down the consequent encroachment. Consequent encroachment, that's the red level, which is essentially just half of the purple shaded area, which is this inefficiency. So we get to the low of that inefficiency again here. What time of day is that? It's 2:41. That's London open. We're looking at this rallying higher. We took this period of short-term highs here. That buy side was taken here. And then where's it go? Right back down into that first displacement in the opening range at midnight. Creates a short-term low. It trades below it again and goes right to the lower quadrant. Look at that. You can't get any plainer than precision. See that low right there? What's that low? 21,705.50. Right? What's the value of the lower quadrant? 21,705.50. The market does what? What is it going to do here? What's it going to do? It delivers on 3:30 macro. In London session at 3:30, that's your sweet spot. At 3:30, the market starts to run away from lower quadrant, first displacement in the midnight opening range. The market rallies aggressively up to some random projected level, negative 0.5, and then creates a retracement, makes a higher high, fails to take out the high, and then we trade back down into the first displacement again, stops dead end at the high at 5 o'clock. Now London session is done. Okay, what's going to take place now? We focus on the day session. Here's how you should take this information and go forward with it, okay? And then I'll close it. I want you to think about how we're finding the framework with this information. The opening range gap, that's your first beginning point. The framework that you use around opening range gaps is derived by the midnight opening range. That's the 12 o'clock to 12:30 Eastern time. Before you even wake up to trade a New York session, you should have at least referred back to that area of price action and carry forward that information like you're seeing right here. You should have at least referred back to that area of price action and carry forward that information like you're seeing right here. I have students all the time. Can you show me London? Can you do something with London? I just gave you the golden ticket to trade in the London session.